Hello and welcome. I'm Andrew Howard, Chief Investment Officer here at Catholic Super, and I'd like to welcome you to this investment update for the quarter ending 30 September 2023. When I last spoke to you at the end of the financial year, I talked about our caution on the outlook for markets, despite having enjoyed strong returns from equity markets over the 12 months to 30 June 2023. Our belief was that there's been somewhat of a disconnect between the positive momentum experienced in equity markets and the underlying economy. To that end, we've maintained our strong focus on diversification, as this is one of the key foundation beliefs of our investment strategy in delivering positive, long-term, real returns to our members. Over the September quarter and into October, we've begun to see a reality check reverberate through markets as the realisation sets in that interest rates will need to remain high for longer as the US Federal Reserve retains its focus on bringing inflation back down to targeted levels. Inflation in the US remains stubbornly high, and the US economy has been surprisingly resilient despite the US Federal Reserve raising interest rates 500 basis points since the beginning of this rate hike cycle. However, it needs to be remembered that there'll be a lag between the increase in interest rates and the subsequent impact on the underlying economy. But just maybe we're beginning to see some cracks appear. In the US economy, the labour market, while strong, may well have peaked, and manufacturing activity looks to be slowing. The environment in Europe is already weak, with Germany entering a technical recession. Structural problems in the Chinese property sector have also come to light in recent months. In addition, the problems within US regional banks were also evident earlier this year. These are not isolated incidents. They all share a common factor, and that's rising interest rates. In addition to the market grappling with the question of how much longer interest rates need to remain at current levels, we now have geopolitical risks at levels not experienced for many years, with the tragic events now unfolding in the Israel-Hamas conflict and, of course, in addition, the ongoing war in Ukraine. And that continues to show no signs of a peaceful resolution. All of this adds to the uncertainty that investors are experiencing right now. And it's in this environment where we're reminded of the importance of being disciplined in the execution of our investment strategy. It's a reminder that it's critical not to react to short-term noise and remain true to our stated investment objectives and goals in focusing on our long-term investment strategy. Our position has not changed. In fact, what's transpired in recent months has only confirmed our belief that we're entering an environment where investors will be rewarded for maintaining a well-diversified investment strategy. Over the past 12 months, we've repositioned the portfolio by trimming equities and increasing our exposure to cash and bonds. And despite the recent sharp rise in yields, we believe that exposure to these traditional defensive investments will assist in providing downside protection over the medium term and lead to a smoother pattern of returns over what we think will be a challenging market environment for investors. If you'd like to find out more information, please head to our website. Thank you for watching.